Okay, we are back. I am with my good friend, Haley Perry. Haley and I, we just had lunch. We're at the clubs of Prestonwood.
It was so good.
It was good, huh? We both had the steak salad. That was pretty yummy. And we were able to catch up because you and Justin just went on a cruise, right?
Yeah.
Your first cruise.
My first cruise, yeah.
Haley's first cruise.
And it was so much fun. Yeah, I'm ready to plan another trip.
Yay! So you survived your first one and you got the cruise bug.
Yeah.
Right.
So that means I need more clients.
There you go. Exactly. So we got to help Haley get more clients. And one thing we were talking about during lunch is the market's shifted, right? It's not the same market that you and I were working in. And even like beginning of this year, definitely not the same as the beginning of this year, because the inventory in DFW was 4,000 homes. 4,000 for a market of a couple million.
Yeah, a lot of people.
That's crazy. That's crazy. And, you know, if you look at a room and you see 50 people there, and all 50 people are making an offer on one home,
Same house.
right? Remember San Pellegrino? That one bottle? The one bottle, right? So everybody was bidding on that bottle. But now there's 3 times the inventory, right? So inventory has actually exploded in DFW. We're now up to 12,000, and it's probably even higher than that. So 12,000 is in June. So now what's happening is because of increased rates, you have buyers that have backed out of the market. So that's number one, right? So you have fewer demand. On top of that, you have more inventory, more supply. So if you're now looking to buy a home, you have so many more options, right?
I know. That's really exciting, especially, you have tons more of coffee, tea, and sugar available.
There you go. So you got all the condiments, right? So now as a buyer, you have choices. And, you know, if you really look at where interest rates have been, they've come down a little bit even since June, right? So they peaked to probably about 6.5%, but now they're in the 5s.
Yep, back down.
And so they've come back down. So if you now are in that position where you don't have to have 50 other, you know, compete against 50 other offers, and you don't have to pay 10 to 20% over list price, right. Now you really have your choice, right? And if you're willing to go forward in this market, not only do you have those options, but your loan is actually going to be closed in record time.
Right.
Right?
And you also have even more flexibility now with the available homes that are on the market.
Yeah, I mean, so when you were submitting those offers earlier this year, I mean, you were submitting offers where buyers had to give up their loan contingency, they had to give up their appraisal contingency, they had to give up inspection contingency.
Everything. And pay over asking.
Pay over asking. I mean, everything. And because you were competing with, you know, you had to compete with cash buyers, right? So the buyer was at a severe disadvantage, right? It was a massive seller's market. But now it's shifted, right? And that opens the door for buyers, right? And you know, what I'm sharing with my clients on the lending side is, okay, so we get that this rate is higher than the 2 and 3%, right? But it took a global pandemic for rates to get to that point.
Right.
Right? So we're probably not gonna see that, right? I don't know if we're gonna see 2 or 3% interest rates, because, I mean, personally, I don't want a global pandemic again.
I was about to say,
I don't. I mean, I want to help my clients as much as possible, but not at the sake of another global pandemic.
Exactly.
I mean, I think people can survive once in a lifetime. Because the last one was in 1913 or something, right? With the Spanish flu.
Way long before I was born.
Exactly. So, yeah, so we don't want any more global pandemics. So we have to reserve ourselves, realizing that, you know what, rates are probably going to be in the 4s and the 5s and the 6s, right? So that's kind of what we're seeing. So if you have that mindset where right now you may not think that rate is great at 5.5% or 5.875 or whatever that amount is, you kind of have 2 ways to think about it. You could think number one is, okay, so let's, I think interest rates are going to continue to go up. Right? So if you have that mindset, then the best strategy is let's pay points, right? And 1 point is equal to 1% of the loan, right? So if you have a $500,000 loan, that means you can pay 1 point, and which is $5,000 towards closing costs, right? So that's part of your closing costs, and you can get a lower rate. Now that doesn't mean it's 1% off your loan, your interest rate, right? Because a lot of people, they're like, yeah, I'll pay $5,000.
Right.
No problem. You're going to give me a 5.5, and I can get a 4.5 by just paying $5,000. No.
We wish.
Yeah, we wish, right? It probably a point. It depends on how we're pricing loans on that particular day. It might give you 0.25%. So if it's at 5.5, maybe 5.25, or even 0.5, right? It all depends on how it's priced, right? So that might get you down to 5%. But it all depends on how it's pricing that particular day. So that's the strategy. If you think that interest rates are going to continue to go up, you pay points. You know that, okay, I have paid the amount that I could pay and I'm comfortable paying, and I'm just going to be locked into that rate, and I'm going to be good with it, right? So I call that the set it and forget it, right? So the Ronco rotisserie. So you might be too young to remember. Do you remember Ronco rotisserie?
I have no idea.
Okay, yeah, there you go. So Ronco rotisserie was an infomercial back in like the 70s and 80s, and they would show this like rotating rotisserie thing, like when they put chicken in there, right? And they call it set it and forget it. So it was this thing.
That's where I thought you were going with it, but I was like, oh, we just got done eating.
Right.
Talking about rotisserie.
but that's the set it and forget it strategy, because they said, they're like, look, you just set the chicken up and everything, and then boom, you hit the start button, and then 8 hours later you get this amazing chicken. Or now you could just go to Central Market and buy a rotisserie chicken on your own.
Right.
But I digress. But the point is, you set up the strategy where, okay, I'm going to have it locked in, and I'm going to be good with it, and I'm not going to look at interest rates again. I'll turn off CNBC, I won't watch Bloomberg, and I'll just be cool with that, right? Because you got the best rate you could. And then you have the other side of the coin, and that is, okay, so you know what? I think, right now we just had inflation, the new report come in, where for July, it came down, right? So now we're at 8.5 from 9.1, right? So if you think that rates may be trending down, maybe not next month, maybe not 2 months from now, but maybe 6 months to the next 2 years or so, then that strategy is, okay, maybe you don't pay points, you pay as few points as possible, but then after you make your first 6 mortgage payments, then you decide, okay, now I'm gonna set it up for a rate alert, and then we'll refi it.
Oh, wonderful.
Right?
Marry the house, date the rate.
There you go. That's exactly the strategy, right? So you just know that, in your mindset that you think that rates are going to come down, right? How I advise my clients, if they ask my opinion, I always say, let's just go with the current data, right? So the Fed, they projected back in June that the inflation rate will come down to 5.4%. Whether you believe it or not, who knows, right? They also projected that, they said that inflation is transitory, right? Back when it was 4 and 5% last year. And they said, let's let it run a little hot. Well, they let it run a lot hot, and that's a challenge, but we now know the next data point is going to be in September, right? So the Fed's going to have an updated report. So I'm always going to be pointing towards the data. And if the Fed changes their, how they feel about inflation, if they're going to revise that up, then maybe it's going to take a little bit longer for interest rates to come back down. But if they're staying firm on that target, where at the end of the year we'll be at 5.4%, I would suspect that interest rates would come down. So I just back it up by data. But I always go based on how the client feels about it, right? So you have those two camps, right? So now, let's get it back into what we talked about when it comes to the shift, right? So in 2008, there was the financial crisis. And afterwards, there were people, they lost their homes, and you could not sell a home, right? And even after that, it took years for the housing market to recover. So if you were selling a home, it could take 6 months to sell, right? And what happened is those buyers, they really had their own choice, right? So there was a lot, there were homes available for sale, but they were requesting that the seller pay for their closing costs, right? And we're getting back to that a little bit, right? Not to that extreme. It's still very much a seller's market, right?
Sure.
Because right now, what would you say the days on inventory is right now in Dallas?
Averaging about 7 to 10.
Oh, 7 to 10 days on market? Okay, got it. So you know, in a buyer's market is 6+ months,
Yeah.
right? When a home stays on the market. But if we're, you know, below 3 months, we're definitely in very much in a seller's market. But there's been more relief, right? So
yeah, last summer the average days on market was 0 to 1 day.
right, exactly. Yeah. So it's increased. So buyers are now getting more leverage. And you know what I wanted to share with the audience, but also talk to you about is, you know, okay, so now we go to an open house and we see the home listed for $600,000, and the seller, they're a little nervous, right? Because they see all the other homes that are going for a similar amount, and some of them are reducing the price, right? So they're quaking in their boots, you know, because there's, you know, coffee, tea, and sugar all over the place, and they're kind of freaking out. So now all the offers are coming in, and they're coming in at $500,000. So, you know, the example we gave is, so Haley and I, we kind of talked about this before during lunch, is, you know, so let's say you have a $400,000 mortgage, right? And let's say that includes all the closing costs and all that stuff. So if you were selling the home for $600,000, your net proceeds would be $200,000. But if you took a $500,000 offer, your net proceeds are $100,000. That's not fun. Right? Especially if you thought that I'm gonna get full value for this house. Right? Like, you know, you were banging on the door and you're like, hey, I'm telling you, now it's time to sell. If you're going to sell this year, February, March, when there was no inventory, now's the time to do that. But they finally woke up, they had the conversation, and they're talking to you now, and you're trying to coach them and say, well, you're going to have to give up some concessions, right? So part of that strategy is now you can go to that seller and say, okay, you know, if you want, you're not going to get the 600,000, right? Because you're getting people coming back at 500,000. But there is a way where you could sweeten the deal for the buyer, right? And that's in the form of seller credits, right? So they can actually, sellers can give a portion of the closing costs where they're paying for a portion of the closing costs to the buyer, right? And that gives some relief to the buyer. And sometimes that relief could be in the form of what, right? It could be, you know, just money to help reduce closing costs, right? So that's one. They could pay points, right? So you could get that rate where if you're at 5.5 and paying 1 point, paying $5,000 as a seller credit, maybe they could get 5.25 on the rate or 5%, right? So that's one way. But then we've got something pretty cool now, right? So I was sharing with Haley, this came from our construction division, right? So when we were in-house lenders at Guaranteed Rate with a builder, we had this temporary buy-down solution. And this thing's pretty cool because the way that it works is we're able to use seller credits and create a loan structure where we can take the first year where if their rate was at 5.5, we can bring it down to 3.5.
Oh, wow. That's amazing.
Isn't that amazing? And then the next year, 4.5. So it goes up 1%, right? And that's why it's called a 2-1. It's a 2-1 temporary buy-down structure. So you've given that buyer so much more relief because, you know, we talked about it, right? The first year in owning a home, it's what? It's the most expensive, right? I mean,
furniture, paint, if you want new flooring in your house, if you want updated appliances. I mean, going to Lowe's on Black Friday and seeing that double decker with 2 freezers in the bottom and a vegetable drawer that you didn't have before, that costs a lot of money.
Yeah, and you're not making that stuff up. Like, you've experienced this with your buyers, right? So you've got a lot of costs. I mean, when Karen and I were building our home, that first year, you know, we put in, you know, new window shades and like all this stuff, right, to make it our home. And then that spending starts to tail off as you feel comfortable and now
make it yours.
And you make it yours. Exactly. So this structure allows you that temporary relief, right? So, we've got the 2-1 as one example, and that costs a certain amount, right? So it's, I've got a calculator. So basically I just put in the loan amount and what their base rate is going to be. And then I put that back in the calculator, right? And it tells me specifically. So I think we were calculating, it was like 612,000 loan amount, 5.875 rate, and it was like 13,500, something like that, right? So that's for the 2-for-1. But let's say the seller's not that generous, right? Let's say I'm going to give you $5,000. Okay, all right. For $5,000, we could do a 1-0 buy down, right? So for the first year, again, remember 5.5 was our starting year. So that would be the base rate. So for year 1 on a 1-0, that's 4.5%. But that's still like $300 in savings, right? So that's still a nice amount of savings. And then we have kind of the halfway where that might be more around like $10,000. That would be a where we go from. So basically, if it's a 1.5 to 0.5. So if we're at 5.5, that would be 5%, right? Or I'm sorry. So that would be so if it's 1.5, so that would bring it down to just doing the math. So if you're at 5.5, 1.5, so 4%, right? So 4%, and then the next year it would be up to 4.5%. So that's the 1.5 to 0.5 buy down, but it gives you that nice relief, right? And that's
time
something
to save and to catch back up and to pick out things that you like for your house.
Exactly, right? So it gives you that relief, but you have to be of that mindset that that your rate in year 3 is going to, if you do the 2-1, is going to be 5.5, right? Or you refi it, right? So you have to understand that either you're going to be at that 5.5 and you understand that, you're going to be cool with that, or you believe that interest rates will trend down between years 1 to 3, and you could refinance. But the thing about refinancing is it's a brand new loan, it's a brand new underwrite, it's a brand new appraisal, so it's not a guarantee, right? So you have to make sure that you still have your financial profile in order and all of those things. So Haley, do you have any other thoughts or what you're seeing where buyers can have that extra leverage, or what sellers are doing?
Absolutely. So even on my MLS right now, homes have dropped over the MLS. 30 to 40% have dropped in home prices within the
percentage of homes that are on the market have dropped prices. So they haven't dropped the price by 30 to 40%, but the percentage inventory has wow. So that's huge.
Half of our inventory that is on the market has had a price drop right now.
Wow.
So that even then, ones that are sitting or ones that were listed back in late June are still there. So we are making our way back up to a 30-day days on market, but it's not quite the average yet. But what I'm seeing is now there's still a couple of multiple offers on the table, but a lot of them aren't over asking, they're under asking, and you're not, you might have 3 offers on the table, and now, just as your example was, a lot of people might just be throwing numbers out there, and so now if you're willing to give the seller what they want, or that particular offer price on the market, or close to it, you can say, hey, if I'm willing to give you an arm and you want $375 for it, we'll give you that if you can pay for the title policy now. Or we also want more option period days. I know during the crazy Dallas market fiasco, some agents and clients were doing 0 option days. So they were waiving.
Take it or leave it, right?
Yeah, they were waiving their option to have any inspections done or anything. So at least now we have that time from even during an open house or when a buyer comes to look at the house, they can actually drive home, sleep on it, and then decide what they want to do, if they want that one or another one, versus before they would have to know by the time they took their shoes off coming to look at the house if they were going to sign papers by the time they were leaving.
Yeah.
Like you had 30 seconds to decide or it was gone.
Wow.
And so, yeah.
That's amazing.
Yeah, and so now at least least, you know, they can go home, not stress about it as much. And then we can strategically work up an offer that makes sense to them. And even, hey, are you willing to leave your refrigerator, or are you willing to leave your washer and dryer? And there are a lot of other things that even with having the buyers ask or offer for what the sellers want, they can still get a few kickbacks that would help them save money in their pockets as well.
Yeah, and you know, I mean, that's amazing. And I think, you know, also on the new construction side, I mean, I feel bad for agents because, you know, like builders, they were your best friend, and they were giving you, you know, they were giving you a fair commission, and like, and just, you know, being able to, you know, they valued you. But some of them, not all, but some of them, they started cutting back on commission. And I even heard that some just like, nah, we don't need agents. We have all the buyers coming to us. That's happened, right? Yeah. So now those builders are like, you know, with their tail between their legs, going back to the agents and saying, okay, we actually do need you.
We want you, bring the buyer.
We want you. And 3 months ago, like I saw these videos where on social media where they had all of these people standing in line. Bidding, but also it was just the opportunity to come off the waiting list.
The waiting list, yeah.
Right? So you were on this waiting list, and there was, you know, you were one of 100 that they were pulled from a lottery. Now, what's really interesting is all of those people that were under contract because of delays and everything else, where their rates had gone from the 3% up to 5%, they have either backed out themselves because they're like, you know, I'm not paying $600 more a month. Not going to happen. Or they couldn't qualify. That was a big a big challenge. And what now has happened is these builders now have inventory of abandoned homes. And now where you couldn't get any incentives, now I'm seeing builders that are offering $20,000 of incentives.
Yep. Crazy.
Just to get a deal under contract, because they're selling them at today's pricing, not back when people got under contract when the home was worth, you know, $100,000 less. But now they're offering massive incentives, right? And they're even saying you could use your in-house lender, which I love.
Me too.
Right? And the reason why, right? So let's break that down, right? So the reason why you would want to have your own representation is because you want to have some leverage in the transaction. You don't want to work with the seller's lender, right? Like, why would you do that? That makes no sense. Right? There's a reason why when you have two parties, why you have two attorneys, you have dual representation. It should be the same way, right? That's always been, you know, my mantra and how I've helped a lot of people with new construction, because they realize they're like, I don't want to give that extra leverage to the other side. I don't care if they're paying me $7,500 in credits and all that. Now there are some people, they will do it either they'll do it either out of convenience or perceived convenience, or they have to, right? They need that extra amount, and I understand that, and that's cool. That's totally fine. But if you're on the fence and you're wondering, that's a big piece, right? You want to have that independent representation, because I'm not beholden to the seller, right? When I work with someone and I'm doing new construction, I'm going to take your contract, I'm going to send you through underwriting right away, right? And then we're going to look at, okay, when should we lock this loan? Do an extended rate lock? You know, we're going to have all those conversations. When you work with the in-house builder, what happens is, you know, their goal is to help the builder sell homes, right? So if it's not to you, it's to somebody else. Right? So they'll put you in underwriting, they'll lock the loan when they feel like it's time to do that, right? So when you have your own independence, you now are in control. And, you know, I'm a little bit on the soapbox, but that's what I'm seeing, right? I mean, when Karen and I, we had the option of using an in-house lender, and they gave us good incentives, but I chose to work a guaranteed rate. You know, I work for the company, I know the people, I know the process, so I like, know, and trust, right? And any incentive didn't even matter, because we had great rates. We were able to lock in. I was able to send my file into underwriting multiple times. As the home was being built, I was able to ask any questions, and I just felt I had that comfort.
Yeah, comfortable.
Right? And then the final piece I want to talk about is speed, right? So I don't know if I even shared this with you, but in addition to all these other cool things we got with the temporary bite out and all that, we also have a new solution, and it's called Fast Track. So Fast Track, So Fast Track, what we did is we looked at all of those loans and trying to compete with those cash buyers, right? And the typical process when we originate a loan is once the home is under contract, we will put everything together and I will lock the loan and then I send it to my processor, right? And then my processor, she will then put everything together and get it ready for underwriting, and then it goes into underwriting. And then the underwriter, they do their due diligence and all that stuff, and then they come back, we have a conditional loan approval. That may take a week, right? We saw a solution for certain buyers, right? So 5% down, conventional, and they can't be self-employed, right? So can't be, all the calculations and all that stuff. But for people that have jobs, right? So W-2 employees, we have a solution where I will send the file to a group that includes the processor, underwriter, closer, and we give them a $250 incentive for them to complete all their documentation on that first day within the 24 hours. And then our goal is CTC within 1 day.
Oh, wow.
So even if you have an appraisal, what we'll do is we'll order that appraisal day one. We will send that file in. The buyer will work on all the documents, and they're going to feel really rushed. They're like, oh my God, like you guys are working so fast. And I'm like, it's okay. It's designed that way. But we just had a huge win where we were able to send out that appraisal. Appraisal came back in 3 days.
Oh my God.
3 days.
That's crazy.
And we were able to get the conditional loan approval in the first day. First day, conditional loan approval. And then we were able to get everything turned back in, and we had our clear to close in 7 days.
That
with
is
an appraisal.
nice.
Isn't that awesome?
Yeah.
That was amazing. Like I became a believer. Like I'm like, all right, they're pitching it. It's another thing. But I'm like, oh man, that is cool.
Yeah. Oh my gosh, see, that gives me goosebumps.
That's the Fast Track, right? And it's called Fast Track. So what the way we set up that loan is, just to give you perspective, is we had, it was listed for 561, and we offered 585, and I was able to run that particular buyer, even though he was putting 5% down. I ran him through an automated underwriting system,
right,
and to see if it was eligible at that price point for an appraisal waiver, and it was.
Nice.
Right? So even though my buyer was putting 5% down, I saw that, and the little bots behind the scenes, it came back and it said, yeah, that home is, eligible for an appraisal waiver. So I got really excited, and so I called the listing agent and I told her, I said, okay, I know we're only putting 5% down, but you priced this really well, because when you price it at 561, I'm still getting an appraisal waiver at 585, right? And an appraisal waiver means that we don't have to order an appraisal, right? So I shared that with her, and she said, I like that. That sounds good. And we actually, the way that we structured the offer is we waived our appraisal. So we said we have to do an appraisal, but we're waiving our appraisal contingency, which means we can't back out of the contract due to an appraisal. But what we did instead is we made the loan contingency on day 12 appraisal, and there wasn't an appraisal contingency. And the goal was to get the appraisal back, come back, and then be able to see what that appraisal came in at. And because they were only putting 5% down, which is the minimum for that buyer, they could back out if they didn't qualify because of the appraisal side, right? So it's gaming the system a little bit, but it works.
It works.
It works. So we were able to come back and clear everything, and it was amazing. And the rest of that transaction, it was like we were on vacation.
Yeah, I was gonna say very smooth.
I mean, I'm like, you guys want to close tomorrow? I mean, like, let's go, right? And they were like, oh no, we want to, that's really helpful. But at that point, it was just getting the final documentation, getting title.
That's quick. They didn't even have time to call the movers.
Exactly. Yeah. I mean, it was so fast. It was amazing. And I mean, but the reason we can do that is, it's pretty, it's ingenuity and all that, but also there's there's capacity, right? Because we're not doing a lot of refis right now. Rates are higher, right? So if someone's at a rate at 2 or 3%, unless they are desperate, you know, to refi, like, I don't know why they would do that, right? I would really have to look at the financials to see if it made sense for that person to refi in this market if their rate's already at 2 or 3%. But some people have to do that, right? Death, debt, and divorce, you know, things happen in life. But as a result, we now have that excess capacity where now we're sending loans in very quickly, and you know, it's interesting because people ask me all the time, right? So I run into people at different events and just advice, and anytime you have chaos in the market and these shifts, people always want your opinion, right? And it's good to have an opinion. How's the market? What's real estate like? What's my home worth, right? So all those questions, right? So I tell people that, and you know, some that I know well, they're like, you know, how's your business been this year? And I say that, you know, at the beginning of the year, I had more pre-approvals than I had ever had in my entire life. I mean, I had like 100 people that were like pre-approvals, right? So I was doing 10 times the effort, but getting a tenth of the reward, right? Because I was competing against 50 other offers, right?
I was gonna say there was more buyers and more letters to go around. Yeah, everyone had a free call letter at the beginning of the year. Everybody. I mean, it was like a national thing where everybody gets pre-approval. You get pre-approval.
It's like Oprah, right? So like everybody got pre-approval letters, but not everybody got homes, right? Because you can only sell one home with one particular offer. So that was a huge challenge. But now, when I have buyers that that understand it, they're motivated, and they want that home, I mean, we are like precision surgeons.
Rocking and rolling.
We're closing fast. We're getting our first offer accepted, and it's smooth, right? So I don't know if it's always going to be that way. Markets change all the time, but right now, if you're looking to buy a home, and you're now where you don't have that huge line of people that you're competing against, and you don't have to bid 10 to 20% over, and you're going to get some relief from the seller. I mean, you were begging for that earlier this year, and we are now there. Right? So any parting words?
Yeah, I was going to say, you nailed it. If you are a home buyer who has been renting or had thought a year ago or 2 years ago to wait, well, waiting is now. So,
right.
Yeah, we are here, we are back around, we have made it full circle, and I'm here to help you, get the best bang for your buck and save as much money in your pocket as I can.
Yeah. And, if you had to, because, you have to live somewhere, if you had to, start a lease on an apartment complex, and you're nearing your 6 months out, Haley and I were talking about it. We're able to get you pre-underwritten. So by the time you need to make that decision, you can either explore home ownership or you can renew your lease. But at least you've done that exercise, right? And that's what we're gonna do, is we're gonna be able to go around, help renters, and we're gonna do the math for you, right? And not only are we gonna do the math, we're gonna get you halfway through the loan process.
Right, and I think that that's another thing that really helps is and I'm the same way, like once I see it on paper, I'm like, okay. Even myself, I'm in the process of buying, and so even when I'm looking, I'm like, oh my gosh, my clients are getting this house with this backyard with their own swimming pool, and they're paying less than me for what I'm paying in rent for a shoebox. And I'm like, no.
Right.
I'm in it with you guys as well, so... I'm here to say if I think it's the right time, then you have to trust me. It's right.
There you go. So Haley, I really appreciate your time today. And you've got a new YouTube channel, right? So why don't you share all your social handles?
So thank you to my great friend Ron and his wonderful videos and getting me out of my comfort zone. But follow me, you guys. Same as everything. It's Homegrown Haley. And I would love to kick it off and share what goes on behind the scenes and a day-to-day with me, and then just throwing out some old archives of some houses I've sold or some clips that we have. So give me a follow and Southern hospitality on the house.
There you go. There you go. So thanks so much for watching. Woo!